Welcome to Illuminati Silver. We tell you the truth about silver. Today is Friday the 8th of November 2019 and we're following up on our videos published on Tuesday and yesterday highlighting that gold and silver prices were not only likely to fall but were falling and may continue to do so for a short while yet. So on Tuesday we published the video entitled Gold and Silver Likely to Fall, at which time gold was $1,501 and silver was $18. And yesterday we published a video entitled Gold and Silver Prices Fall Even Further. Now we've placed links to both these videos in case you haven't had the opportunity to listen to them in the description box below. And we ended yesterday's video with the words, quote, "Meanwhile, watch this space. We may very well see some further moves in both gold and silver before the week is out," unquote. Now, at the time of writing this today, the time is 11:20 GMT, and gold stands at $1,465, and silver has dipped below the $17 level at $16.96. It'll be interesting to see how they actually end on the day. If both recover a little, then that will prove positive. If, however, they maintain these levels or lower, then that may suggest something going into next week, but we will cover that in tomorrow's weekly update. So, today we wish to focus more on gold, as we had prepared a brief planned for Wednesday, but were unable to upload it due to technical difficulties at our end, i.e. no internet connection. And we highlight how gold demand is currently being affected, the conclusion of which being that if it were not for ETF inflows, then gold prices would be considerably lower. So let's just take a look at the report published by the World Gold Council, which we actually covered on Wednesday. So let's take a look at this report from the World Gold Council. Gold Demand Trends Q3 2019, published 5th of November. Headline: Surge in ETF inflows supports Q3 gold demand growth. Gold demand grew modestly to 1,107.9 tons in Q3, thanks to the largest ETF inflows since Q1 of 2016. A surge in ETF inflows, 258 tons, outweighed weaknesses elsewhere in the market to nudge gold demand 3% higher in Q3. Although central bank buying remained healthy, it was significantly lower than the record levels of Q3 in 2018. Jewelry demand, and then we see in brackets minus 16%, was hampered by the continued strength in the gold price, which hit new multi-year and in some cases record highs, as well as by consumer concern over the health of the global economy. So we all know, for example, the record highs have been in United Kingdom, Australia, and a few other countries, and multi-year high in the United States. Similarly, the decline in bar and coin demand, now notice this figure, minus 50%. The decline in bar and coin demand minus 50% in Q3 was driven primarily by the gold price. Retail investors took the opportunity to lock in profits rather than making fresh purchases. Now that is crucially important. Now you can see why the pumpers are out in force, those with links to bullion businesses. Why are they out in force telling you 10,000 gold just round the corner? Because the demand for the physical is down. Forget the nonsense about manipulation driving prices down, because gold prices have been going up. And yet the demand for gold, physical, bar and coin, at least by retail investors, has gone down. If it wasn't for the ETFs, demand would have shrunk. So similarly, the decline in bar and coin demand, minus 50% in Q3, was driven primarily by the gold price. retail investors took the opportunity to lock in profits. Now, technology demand for gold fell 4% as economic challenges remained, but the nascent 5G infrastructure helped to slow the decline in the important electronics sector. With mine production virtually unchanged, a price-related 10% jump in gold recycling boosted gold supply 4% to 1,222 tons. So, you have gold demand 1,107.9 tons and gold supply 1,222 tons. So, even though supply exceeded demand, the price still went up. But if it falls back, as it appears to be doing, one should not be surprised if you base it on supply and demand. That's not the only effect, we fully appreciate that. But supply has exceeded demand in this quarter. Now, if we have a look, this chart shows us quarter 3 of last year compared to this year. So, central banks last year, 253 tons. This year, 156. This quarter. Total bar and coin demand was 298 tons last year's quarter 3. This year's quarter 3 is 150 tons. It's actually 148 tons less. That is the dramatic fall. If we look at technology, 85 versus now 82. Jewelry, 546. Jewelry, 460. This is the big one. ETFs, minus 103 tons, but this time plus 258 tons. So if it were not for the ETFs, the gold demand would have shrunk dramatically. So, highlights. Holdings in gold-backed ETFs hit a new all-time high of 2,855.3 tons in quarter 3. Holdings grew by 258.2 tons during the quarter, the highest level of quarterly inflows since quarter 1, 2016. Accommodative monetary policies, along with safe haven and momentum buying, drove demand. Do you remember the video that we produced where we basically said the demand for gold and to a lesser extent silver was now going to be driven more by investment purposes than for industrial purposes? Not revolutionary, but logical. Central banks added 156.2 tons to reserves in quarter 3, so they're still adding, but that is down 38%, a year-on-year decline. Partly due to quarter 3 last year being the highest quarter of net buying in record history. Jewelry demand was down 16%. Bar and coin investment halved in quarter 3 to 150 tons. This is why so many of the pumpers are out stating dollar collapse, gold going to $10,000, silver going to 30, then 50, then $100 anytime soon. They are desperate to make the sales. Gold supply rose, but essentially through recycling. But the good news for those holding it, the gold price continued to rally, reaching new multi-year highs. 5% during quarter 3, finding sustained support around 1,500, which is what we've been emphasizing in all of our videos. If you recall, 1,500 gold, roughly 1,750 silver. Okay, that's the end of this segment. So, there we have it. Central bank buying, healthy but down. Technology demand down by 4%. Jewelry demand down by 16%. And coin and bar demand down by a whopping 50%. Gold supply through mining, little changed. But recyclables increased overall supply by 4%. So based purely on demand and supply, we should not see a strengthening in the gold price. If ETF demand falls, which is possible because of monies moving back into equities, then even lower gold prices cannot be discounted. That said, we still foresee issues in 2020 to 21. So for those light in gold, it may indeed prove a good time to buy as these dips occur. Thank you for listening. And if you haven't already done so, please subscribe and press the bell sign so that you are notified of future videos as they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.